Imagine working nights and weekends for like 3 years straight to build your business.
Oh, yeah, the endless hustle.
Right. You sacrifice, you grind, and you finally hit that elusive six-figure revenue mark.
Best feeling in the world.
Exactly. But then a vendor slips on the steps of your office, they sue you, and because you skipped one basic, seemingly minor administrative step at the very beginning,
They don't just take the business bank account.
no, they take your family's house,
Yeah.
they take your personal savings, everything.
It is honestly the absolute nightmare scenario for anyone trying to build wealth. And I mean, what is truly wild about that scenario is how entirely legally preventable it is.
Totally. And that's exactly what we're getting into today. We're
Yeah.
talking about building a structural shield to achieve absolute peace of mind.
I love that phrase.
Yeah, because our mission with this deep dive is to find the path of least resistance to stress-free wealth. We're taking official U.S. Small Business Administration guidelines, IRS tax classifications, and some incredibly dense academic legal research from places like DePaul and Emory University.
Very dense,
Yeah,
yes.
so extremely. But we are stripping away all that intimidating jargon. Whether you're an up-and-coming entrepreneur or, just an everyday person starting a side hustle, or even if you're completely rebuilding your life from the ground up, we want to show you how accessible and vital setting up a limited liability company truly is.
It really is the foundation.
Okay, let's unpack this. Let's start with the basic blueprint of this shield. What are we actually talking about here?
Well, the SBA defines an LLC fundamentally by its hybrid nature, and that word hybrid is really the key to understanding the mechanics here.
How so?
So historically, you kind of had to make a hard choice. You could operate as a massive formal corporation, right? Which gave you excellent liability protection.
But it's a huge headache.
Exactly. You're subjected to this rigid, complex, heavily taxed structure. Or, on the flip side, you could operate as a simple partnership or a sole proprietorship.
Which is super easy to run.
Super easy, very tax efficient, but, and this is a massive but, it left you completely exposed legally, like walking a tightrope without a net.
Right. If you just start selling a product today without registering a formal entity, you're a sole proprietor. You have unlimited personal liability.
Right. If the wind blows too hard, everything you own is on the table. But the LLC borrows the absolute best parts of both worlds.
So it's basically taking the heavy-duty asset protection of a corporation and merging it with the easy breezy tax benefits of that simpler structure.
Precisely. What's fascinating here is a concept that the academic literature calls vertical protection or inside liability.
Okay, vertical protection. Give me
Okay.
an analogy here. I kind of think of an LLC as like a financial hazmat suit.
I like that. Or think of it as a waterproof bulkhead on a large ship.
Oh, like the watertight compartments.
Exactly. A ship doesn't just have one massive hollow hull, it's divided. So if we look at vertical protection, the business is just one of those compartments on your ship.
Gotcha.
If that specific business compartment hits a reef, say it faces a massive lawsuit from a client, or it just runs out of cash and goes bankrupt, that compartment might flood and sink.
But the rest of the ship stays afloat.
Right, because you installed the LLC's waterproof bulkhead, the water stops right there. It physically cannot spill over into the other compartments of your life.
Wow. So your personal bank accounts, your house, your kids' college funds, they're entirely shielded. The business liability is trapped strictly inside the business.
Exactly. Setting this up is really the smartest first step to sleeping soundly at night.
Because it fundamentally changes how you operate daily. When you know your personal family assets are off limits to business creditors, you aren't making decisions out of this like creeping anxiety.
You can take calculated risks.
Right. But, okay, let's pivot. Protecting personal assets from the business's mistakes is amazing. But what if the threat comes from the outside?
Ah, the reverse scenario.
Say you get into a personal car accident or someone sues you personally, completely unrelated to your business. Does this waterproof bulkhead work in both directions?
It does. And this naturally leads us to what researchers call horizontal protection, or outside liability.
Okay.
If a creditor gets a judgment against you personally, they're going to hunt for your most valuable assets. And if you own a highly profitable LLC, that ownership interest is a major asset.
Sure, it's worth a lot of money.
Right. However, the The LLC shield provides a legal mechanism known as charging order protection.
Wait, a charging order? Let's break down the actual mechanics of that, because honestly, that just sounds like a piece of paper a creditor would use to force you to liquidate your company.
Well, that's exactly what they want to do, but the charging order actually stops them.
Oh, really?
Yeah. In a standard corporate structure, a creditor could just seize your shares and vote to liquidate the assets. But with an LLC, the court limits the creditor exclusively to a charging order.
Meaning what, practically?
It means the creditor only receives the economic right to any financial distributions that the LLC decides to pay out to you.
So they don't get any control.
Zero. No voting rights, no management control. They can't force their way inside to sell off equipment or drain the bank accounts.
Wow. So the creditor is essentially stuck standing outside the fortress walls. Like, if you decide the business needs to reinvest all its capital that year and not distribute any cash, the creditor just sits there holding a piece of paper, getting nothing.
You got it. The business just keeps operating, totally unhindered by your personal financial disaster.
Okay, but wait a second. I'm looking at this research from California State University, Northridge, and they highlight a pretty severe vulnerability here.
Ah, the single-member trap.
Yeah. They warn that if you're a single-member LLC, meaning it's just you, no other partners, this horizontal shield might actually have a crack in it. How does that work?
It's a brilliant legal trap to understand. See, the entire justification for limiting a creditor to a charging order is to protect the other innocent co-owners of the business.
Well, that makes sense.
Right. The court's logic is, hey, it's unfair to force the liquidation of a company and ruin a business partner's livelihood just because you personally racked up outside debt.
But if you're the sole owner,
Yeah.
there is no innocent partner to protect.
Precisely. Because of that, courts in certain states, Florida is a very famous example here, have looked at single-member LLCs and allowed personal creditors to pierce right through that horizontal shield.
So they let them foreclose on the business anyway.
Yeah, they allow creditors to liquidate the business assets to satisfy the personal debt, basically arguing the protection serves no purpose if there's only one person in the room.
That completely neutralizes the outside shield for, like, millions of solo operators. So what is the path of least resistance to fix that?
The researchers point to a surprisingly simple structural fix. You just introduce a second member to the operating agreement.
Just add a partner.
Yeah, you structure it as a multi-member LLC, and that restores the legal logic that innocent partners must be protected.
Does it have to be a 50-50 split?
Not at all. Even if that second member, say a spouse, a trusted family member, or even a holding company you own, only has a 1% non-voting interest, their mere presence ensures the charging order remains the exclusive remedy. The bulkhead holds.
That is wild. Just a 1% allocation keeps the creditor outside the walls.
Exactly. And, while we're talking about structural fixes, the Emory University research brings up something really cool called series LLCs.
I saw that. I want to understand the real-world application of this, because it sounds like taking the bulkhead concept and applying it to a massive fleet of ships.
That is the perfect way to visualize it. Let's say you're building wealth through real estate, right? You buy 5 different rental properties.
Okay.
If you put all 5 into one standard LLC and a tenant at property A sues you for a severe injury, the equity in properties B, C, D, and E are all exposed.
Because they're in the same hall.
Right, they share the same single entity.
So the traditional fix is just opening 5 separate LLCs. But frankly, paying 5 filing fees, hiring 5 registered agents, filing 5 tax returns, that sounds like a massive administrative friction.
It's a nightmare. Which is exactly why certain states introduce the Series LLC. It lets you create one master LLC, and underneath it, you establish separate compartments or series.
Okay, so Series A owns property 1, Series B owns property 2.
Exactly. And the law treats each series as a completely separate entity for liability. So if disaster strikes property A, the lawsuit is entirely confined to Series A.
The other properties are walled off.
Yes. But you only have the administrative overhead of maintaining one overarching parent company.
Okay, that is elite asset segregation.
Yeah.
So we've got the physical architecture of the armor down. We know how to lock down assets. But let's pivot, because the goal isn't just playing defense, right?
Right.
The goal is building wealth efficiently. So how does this structure actually help with taxes?
Well, to understand that, we have to look at how the IRS views an LLC, which is essentially that they don't.
They don't.
No. When you form an LLC, the IRS doesn't have a specific tax category for it. They assign you a default classification based purely on your ownership structure.
Okay.
If you are a single member, they call you a disregarded entity, and business income flows directly onto your personal tax return, usually on a Schedule C.
And if you took the advice and added a 1% partner?
Then the IRS defaults you to a partnership classification, filing Form 1065, which also passes profits directly through to the owners.
Both of those sound great because you avoid double taxation. But the major pain point here is the self-employment tax, isn't it?
Oh, it's a heavy burden. With those default structures, generally all your net profit is subject to a 15.3% tax for Medicare and Social Security.
That is a massive margin to surrender before you even touch standard income tax brackets.
It really is. But the LLC is highly adaptable. You aren't forced to accept that default status. You can elect to have your LLC taxed as an S corporation.
Here's where it gets really interesting. Because the S-Corp election fundamentally redefines your relationship with your own company, doesn't it?
Yes, it does. You're no longer just the owner. You become an employee.
Okay, and as an employee, the IRS says the business has to pay you a reasonable salary.
Right, for the actual labor you perform. Now, that salary is absolutely still subject to the 15.3% payroll taxes.
Sure, you can't dodge that entirely.
But the magic of the S-Corp applies to the revenue left over after you pay your salary. Any remaining profit can be taken out as an owner's distribution.
And those distributions are legally exempt from the 15.3% self-employment tax.
Exactly.
Let me push back on this a bit, though. Running formal payroll, issuing yourself a W-2, paying an accountant, that introduces real financial and administrative costs. Is the squeeze actually worth the juice here?
It's a very valid concern. That's why financial professionals rely on a specific mathematical threshold. The general consensus is that once a business starts generating roughly $60,000 to $80,000 in net annual profit,
That's the sweet spot.
yeah, that's when the tax savings of the S-Corp aggressively outweigh the cost of running payroll.
Let's run that math to make it concrete. Say your business nets $100,000. Under the default LLC, you pay that 15.3% on the entire $100K.
Right.
But under the S-Corp, maybe you determine a reasonable salary is $60,000. You pay the employment tax on the $60K. But the remaining $40,000 of profit,
You take that as a distribution.
you just legally bypassed the 15.3% tax on 40 grand. That's saving over $6,000 in a single year, purely through a structural election.
It accelerates wealth accumulation significantly. But I should note, there is a catch.
The IRS always has a catch.
Always. They don't hand out that kind of advantage without strict boundaries. You're legally capped at 100 shareholders.
Okay, pretty generous for a small business.
True, but every shareholder must be a U.S. citizen or legal resident. No foreign investors, and you can only issue a single class of stock.
Meaning no preferred payout rights for certain investors.
Exactly. Keep it simple.
Okay, so we've got the armored hull, we've optimized the tax engine, but we need a serious reality check here.
Yeah.
A shield is completely useless if you constantly, drop it.
Right, if you don't maintain it.
I see entrepreneurs do the paperwork, pay the filing fee, and then just operate their business out of their personal checking account. How does a judge look at that?
This is a crucial point about the fragility of the system. What you're describing is a failure to maintain the corporate veil.
The corporate veil.
Yes. The legal system only grants you this extraordinary protection if you genuinely treat the entity as a completely separate person. If a judge sees your financial habits and decides the LLC is merely an alter ego, just a fake shell for personal convenience,
Then what?
they will execute what is called piercing the corporate veil. Your waterproof bulkhead evaporates instantly. Personal assets are fully exposed.
It's like being an actor who breaks character on stage.
Oh, that's a great way to put it.
Yeah, like if you're in a deeply dramatic play and you suddenly pull out your smartphone and start laughing at a text message, the audience stops believing the illusion. If you treat the business account like your personal wallet to buy groceries, a judge is going to say the business is an illusion.
You broke character.
Exactly. So how do we maintain the illusion?
You have to enforce rigorous daily operational formalities. The absolute most critical step is dedicated banking. You can never, ever commingle funds.
It sounds so basic, but it's the #1 reason the veil gets pierced. Business revenue goes into the business account. Personal expenses from the personal account.
Right. And if the business needs to pay you, use documented owner draws or salary instead of treating the register like an ATM.
What about identity?
You must establish a public identity. Get an EIN from the IRS. It acts like the business's social security number. And crucially, whenever you sign a contract, you never sign just as yourself.
You sign with your official title, like Jane Doe, manager of XYZ LLC.
Exactly. You are an agent of the entity, not an individual.
And to make this a frictionless habit, the research points to using open source tech. Free tools like ERP Next or Odoo.
Oh, those are lifesavers.
They automate your bookkeeping, right? And they create an undeniable time-stamped paper trail proving the business operates independently.
They create the evidentiary proof you need for a judge.
Perfect. Okay, so the LLC and the corporate veil handle the day-to-day survival. But how do we escalate this? How do we take the capital we've shielded and secure it for the next generation?
If we connect this to the bigger picture, setting up an LLC is your daily armor. But a trust is the fortress you leave behind for your family.
The ultimate vault. But trusts are notoriously dense.
Yeah.
Can you break down the mechanics of how a trust actually protects wealth better than an LLC?
Sure. It comes down to legal ownership. A trust is built on 3 pillars. First, the settlor, that's you, the creator.
Okay.
Second, the trustee, the person or institution managing the assets based on a rule book you wrote. And third, the beneficiary, usually your kids, who eventually receive the wealth.
So if I move my house and my stock portfolio into an irrevocable trust, what actually happens to my ownership status?
This is the aha moment. When you place assets into an irrevocable trust, you, the settlor, legally no longer own them. The trust becomes the legal owner.
Wait, really? Let me push back. The whole point of building wealth is to have it. Why would I give away legal ownership of my own stuff?
It sounds like a paradox, I know. But giving up ownership is the exact mechanism that generates ultimate creditor protection.
How?
Imagine a catastrophic lawsuit completely pierces your LLC's veil. They come after you personally. They search public records for assets in your name.
But my name isn't on the deed anymore.
Exactly. The trust's name is. A creditor cannot legally seize an asset that you do not legally own. You sacrifice technical ownership to achieve absolute impenetrable protection.
That is fascinating. It's walled off because it belongs to this separate, immortal rulebook I created. And what happens when I pass away?
That's the second massive advantage. It completely bypasses probate.
Which is an expensive public nightmare.
Right. Probate drains the estate with fees, and anyone can look up your family's finances. But because the trust never dies, there is no probate. The trustee just distributes the assets privately and instantly, exactly as you instructed.
It truly is the pinnacle of the structural shield. Okay, let's recap this entire journey.
Let's do it.
We started with the foundational layer, the LLC. It builds a waterproof bulkhead for vertical protection, keeping business liabilities away from your personal life.
And we covered horizontal protection, using a multi-member structure to secure charging order protections and lock out personal creditors.
We even touched on series LLCs for isolating real estate risks. Then we optimized the engine with the S-Corp tax election, bypassing that 15.3% self-employment tax.
As long as you follow the IRS rules.
Right. And we locked it all down by maintaining the corporate veil-dedicated banking, formal signatures, software like Odoo. Finally, we looked at the ultimate legacy vault, trust architecture.
Surrendering legal ownership for absolute probate-free protection.
So what does this all mean for you? If you're sketching an idea at your kitchen table or scaling up a side hustle, setting up this structural firewall is highly accessible. It doesn't require a law degree. It's the path of least resistance to protecting your hard work.
We spend so much time worrying about market conditions or competitors sinking our business. But consider this. What if the biggest threat to your wealth isn't the economy at all, but simply the everyday administrative habits you are choosing to form right now?
That is a powerful reality check. The habits you build today become the fortress that protects you tomorrow. Thank you so much for joining us on this deep dive. Take that easy first step today and operate with absolute confidence. Until next time.